Now, when we talk about the credit, the quantum of taxes which are withheld in the source state, for which the state of residence should give credit, the question which comes up is, what is the amount of tax for which the credit should be given? Now, to explain this point, while we are talking about underlying credit, let's just first understand a few points over here. Suppose there is a non-resident who owns an Indian company, right? And he owns shares beyond a specified percentage, let's say anything like 20%. Now, the Indian company earns an income of $100 on which it pays a corporate tax of 30. And therefore, what they are left with is $70. This $70 is paid by them to the non-resident as dividend. Right? When you pay this as dividend, let's assume a case where there is a withholding tax in India for 10% of the dividend, and we just take it directly as $7. I know some of you might be thinking that the methodology for computing this is different in India because the company has to pay a dividend distribution tax, but we just want to clarify this point over here, so just look at these facts. So what is the total tax which has been paid before the money actually received the non-resident? So $30 was the income tax which was paid, $7 is the withholding tax which is paid. Let's say, for example, the non-resident in his home country has to pay a tax of 20% on this 70, which is $14. Right? Now the question which comes up is, what should he get a credit for? Should he get a credit for only $7? Or should he claim a credit for 7 plus 30, $37? The difference is, if he claims a credit only of $7, right, he has to pay $7 more to his country of residence. As against this, if the credit were to be available for 7 plus 30, $37, then effectively he doesn't need to pay any more taxes there. The second situation where the non-resident is entitled to the credit of 30 plus 7, $37 is known as the underlying credit. Underlying credit has been the taxes which have been paid on the underlying income out of which such dividend has been declared are also considered as tax paid by the non-resident. So in the present case, the taxes may be paid by the Indian company and the shareholders on dividend distributed out of the remaining profits. In case of underlying credit clause, the state of residence, which is this state, grants credit of corporate taxes paid by the ICO, which is $30, and the withholding tax on dividend, which is $7. So effectively, out of $14, you have $37 of credit. So you will reduce $14 here, making it 0. We do not reduce $37 here because the credit is limited to the amount of tax which has to be paid in the state of residence. One of the clauses which we have in this context is the one in India-USA treaty. It says, in case of United States company owning at least 10% of the voting stock of a company which is a resident of India and from which the United States company receives dividend, the income tax paid to India by or on behalf of the distributed company with respect to the profits out of which such dividends are paid. So out of the profits from which these dividends are paid, if on those profit you've paid any taxes, you are entitled to the credit. The condition is you have to own at least 10% of this voting stock, of the Indian company. Tax pairing. Suppose there's a non-resident who has a PE in India, which is claiming certain tax holidays, right? What that means is that the profits of the PE are exempt from tax in India, right? Now, if India grant incentive and exempt profits of non-resident, as in the PE, from tax in India, if the resident state tax such profit, no benefit shall accrue to the investor. So effectively, if suppose this PE is into exports and for any reason Indian government exempts the profits arising from such export, right? If the Indian government levies a profit tax of 0 on these profit, but these profits are included by the non-resident in the taxable profit of this company and they charge a tax of $40, the total tax he pays is $40. Right? Now, when you talk about the investor, for him, it doesn't matter whether India applies a tax rate of 30 and the non-resident applies a tax of 10 and he pays total $40 as taxes, or if India puts in a $0 of taxes and the non-resident applies 40, because in both the cases he has to pay $40 as taxes. So he would not have any incentive to invest into India. In such a case, some of the treaty countries may agree that if India grants an incentive to the non-resident and does not tax the profit of the non-resident in India, then they may agree, the treaty partners may agree to forego the taxes which have been spared under the incentive program in the source state. So instead of taxing these profits, they were also going to spare them from taxes. And how? Either by exempting them from tax. So you say, okay, we are going to exempt them from tax, they will not be included as a part of total income, or providing a deemed credit for taxes not levied by the source state. So even if the taxes are 0, you say, what would have been the tax which would have been paid here? Let's say it would have been $30. We will provide you a deemed credit of $30, right? And tax you only for the remaining $10. So that the total tax which the non-resident has to bear from a cash perspective is going to be 0 plus 10, only $10, right?